Good morning and welcome to the latest in the IMAP webinar series. My name's Toby Potter and I chair IMAP, and it's my pleasure today to introduce David Wright as our co-presenter today on our webinar on the state of managed accounts. Today we're going to be talking about a number of aspects of managed accounts. We're going to be talking about the size of the market and our recent FUM census. David's going to be talking about investment issues around managed accounts and the way in which managed accounts are responding to these market circumstances. And then to conclude, we're going to be talking about regulatory issues. As we go through today, if you have questions, at the top or bottom of your screen, you'll see a Q&A icon. Feel free to click on that and to type in your questions, and David and I will attempt to answer them as we go through or at the end. So David, welcome to today's webinar.
Thanks very much, Toby. Obviously pretty timely and looking forward to participating.
Yeah, that's right. So today's really a type of webinar that I'm sure you'll be seeing a lot more of over the next 6 months or so. There are electronic communication and digital communication is going to be the only way in which we can communicate amongst ourselves, and I really mean that is amongst ourselves as a community. This is going to be a key way for us to communicate between industry professionals and between advisors and clients. So I guess we're all going to get used to Zoom, GoToMeeting, and WebEx. There are a couple of questions which have come up already, and those look like questions which David, you should be able to pick up as we go through. But let's start off by just talking about how IMAP is responding to COVID. IMAP obviously runs a lot of events through the year, some webinars like this, others face-to-face. And so for the duration, those face-to-face and in-person events aren't going to be able to be held. We've deferred the advisor conference that was to be run in Sydney and Melbourne. And that conference was on professionalisation, the way in which advice firms are becoming more professional as businesses, as FASEA and the Code of Ethics and ASIC requires individual advisors to become professionals. So managed accounts have been part of advice businesses becoming more professional. Now we're in fact going to hold that conference in April in a digital sense. So we're going to present the sessions in, I think, the 3rd week of April as a set of 1-hour seminars, and we'll be, and then when we're all allowed to get back together again, we'll be holding an event in both Sydney and Melbourne to enable us to address those issues of professionalisation face to face. The awards which we run each year are normally run for a June awards ceremony. That's not going to be possible this year, and I'll talk a little more about the awards in a moment. The portfolio management conferences which we run in August, just in case we're still in this lockdown mode by then, we're transferring those to November, because the portfolio management conferences are so important as a way of demonstrating how managed accounts ought to be run and operated. And we're bringing Investec to September to avoid conflicts between the portfolio management conference and Investec. Our next webinar on real asset investing and infrastructure investing on the 8th of April with First Sentier and Morningstar. But the other thing I wanted to talk a little about are our communities of interest. These are groups that operate pretty much remotely anyway, with the data standards group, the regulatory group, and the portfolio management group. And I'll be talking more about the regulatory group at the end of this webinar. The data standards group has had 20 organisations participating in it as a way of developing standards for the transfer of data between managed account administrators and managed account model managers. It's already published the first standard of how to transfer model information from manager to administrator or manager to platform, and it's currently at a pretty final draft for FUM data and flow data by model. So expect to see those shortly. The awards. We've run, this will be the third year we've run the awards. There are 7 categories. 5 are asset class awards. So Aussie equities, small caps, multi-sector, international equities, fixed interest. 1 is innovation. What do you do that contributes to managed accounts, and in what way is it innovative? But the 7th, and to my mind, arguably the most important, is the licensee award. This is licensees who are managed account providers or who run portfolios for their advice business. The award is given to an organisation that can demonstrate how it both manages its portfolios, but also how that is consistent with its advice philosophy. If you're involved in managed accounts, I'd urge you to participate in those. So let's now talk about the December FUM census, which we've just published. Look, in the second half of 2019, managed accounts resumed rapid growth. 28% year on year in terms of total FUM to a pool of about $80 billion. That's about 10% of the total platform market. Now, obviously not all managed accounts are run on platforms, but to put it in context, that $80 billion needs to be measured against about $880 billion of assets on platforms. There was a slow period of growth through the first half of the year, but once the Royal Commission was behind us, the use of managed accounts grew. And that was at a time when markets weren't at that stage exhibiting terribly strong growth. Now, how's that been made up? So you can see here that we divide managed accounts into 3 categories. SMAs, or managed investment scheme versions. These are registered managed investment schemes. That's currently seeing the fastest growth year on year at about 36% from December 2018 to 2019. MDA services, or MDAs, remain the largest pool of managed account assets. And then other, there's always another, at about $18 billion. In total, about $80 billion. Grew about $8 billion in the last 6 months, growing at about 28%. So that's a little about the background of what IMAP is doing in response to the coronavirus or COVID-19, and a little about the size of the managed account market. And now it's my pleasure to hand over to David to take us through his view of how the markets, how managed account are offering an opportunity for portfolio managers to manage portfolios for clients. So David, over to you.
Thanks very much, Toby, and thanks everybody for joining the webinar, and trust everybody's doing okay in, let's face it, what's a sort of very challenging environment. So I wanted to start with, I guess, sorry, just having trouble controlling the screen.
Let's just go back to why don't we have a...
Yeah, so we'll get to, thanks, Toby. Yes, I mean, I guess the natural question, and let's face it, this is an extreme environment for this to be tested, but you know, are managed accounts actually working? And in our experience, is very much predominantly in the SMA and managed investment scheme space rather than MDA. But to date, the answer is broadly yes. And what do I mean by that? Well, those of our clients that have established managed accounts, we're managing the portfolio, the reporting, the execution, initial construction and so forth, have been able to make portfolio changes through this market volatility where it's been required. So at times that's been switching or removing managed funds and fund managers out of portfolios, but for the most part it has been in really the portfolio activity has been around rebalancing. And again, that's obviously very challenging in this environment where markets are whipsawing around. But when we have equity markets, you know, down sort of 30, 35%, it's no surprise to anyone that the portfolios across the risk profiles extensively have become distorted and unbalanced with the defensive being overweight and growth assets predominantly being underweight. So we've needed to take some portfolio rebalancing action. That has been able to occur. I note there is a question about the volume of trading that is going on through the platforms and potential slippage and also potential for human error through that. I think that's a non-trivial issue, to be honest, in that you'll see with the sort of bottom point there, there's no doubt that, as I said, this is an environment that the platforms and their ability to transact and managed account managers to be able to execute has really been very much tested. And in our own experience, there has been, it's certainly been a slower process than normal through normal trading and execution and brought about by the high volume. But we have been able to get those transactions and portfolio readjustments through, which is the key part. I mean, we've had the comment from a number of those clients that have established their managed accounts or separately managed accounts, as many of the market call it, that there's no way they would have been able to manage their client portfolios had it not been for operating through a managed account structure. So that's been encouraging to hear that. I guess the other key part there, and you know, we all need ongoing communication to the end investor, and that's, you know, from all of the underlying managers, but also from managed account managers like ourselves. And the ability to do that on a client by client basis in such volatile times is you know, really going to be impossible. Whereas the ability to do that through a smaller set of portfolios where the majority of clients are invested through managed accounts has been much more easily facilitated. And so I think that's key to one of the benefits of managed accounts through a market downturn and volatile market environment, is that ability to communicate, tell the underlying investors what's going on in the portfolio, look through reporting to underlying asset allocation, cash holdings and the like, short positions, ability to protect the portfolio basically is key to, I think, the transparency and communication that, you know, managed accounts is able to bring in a much more efficient way. as I mentioned, you know, platforms very much under pressure. We have been able to execute, albeit it has been more laborious. You know, I do think not all platform trading execution is completely automated. And I think with more and more people working from home, there certainly is that potential for, you know, for human error to come in. So that's something that, again, as an industry, and certainly from our perspective, you know, we've got multiple people overseeing that trading and execution, because that really is where mistakes can be made. I think you're controlling the slides now, Toby. So to the next one, what are some of the developments we've seen in managed accounts? Well, certainly prior to all of this market volatility, we did and had seen a strong demand for lower cost portfolios. Let's face it, everybody had become very, very price sensitive. And as a result, we were seeing that playing out in terms of the demand for constructing and provision of lower cost options for some advice groups. That often went alongside sort of, you know, I guess fully active, full octane portfolios, for want of a better term, but just the ability to provide clients with an option, and at times the ability to compete with industry super fund holdings and so forth. Look, that wasn't, I mean, if you really want, I guess, the lowest cost and completely passive, as we know, there's a number of places through the various index and passive managers where you're able to get that. So the demand for us was certainly lower cost, but not completely passive. So use of some passive in asset classes where they're much more efficient and active managers don't have the same strike rate of outperforming, but also, I guess, smart beta type and or quantitative options being used in those portfolios to keep costs down. The other thing that we had seen is also increasing demand for dedicated retirement and drawdown portfolios. Now, I'd argue that the focus on sort of dedicated retirement or drawdown solutions was gathering pace prior to the launch and facilitation of managed accounts. The launch and availability of managed accounts, I think, put that on the back burner for, you know, probably the last 3 years. But now we're starting to see groups that have established managed account portfolios coming back to us and saying, okay, this has really helped in the efficiency of how we run our business. We've transferred where we can those clients in the business that the managed accounts are appropriate for, but it would be great to have a set of you know, bespoke or specific retirement and drawdown portfolios. So we are starting to see an increased demand for those types of portfolios with, you know, I guess the sort of key probably characteristics, or the more common characteristics there, are higher income levels, lower market drawdown, and as we know, there's no sort of free lunches in that. You know, you're not going to participate in full market upturns with a portfolio structured in that way, but that tends to be the protection of capital. Delivery of income is really what the majority of retirees are requiring. Now, I guess the other thing that's occurred with the popularity of managed accounts and SMA portfolios is the potential for the investment costs to be reduced. And the way, I guess, the managers look at that is it is more efficient business. You know, it's not institutional, but at the same time, it's not rats and mice in terms of pure retail. And as a result, the ability to service that, in theory, comes at a lower cost. So we certainly have seen managers being receptive to fee negotiations for volume. Look, I will admit the majority of that at the moment has come by way of a rebate arrangement, which has its own issues. Whereas other managers, or some managers, and I'm talking now probably only 10% at this stage, have created a dedicated unit class for managed account investment, which is at a lower price, and really is much more simpler from an administration perspective for platforms, more understandable by investors, and certainly easier for the fund managers themselves. So I personally think the creation or availability of lower priced unit classes for managed account monies is going to be the way that the industry goes in future. I guess the other thing, Toby talked about the growth in managed accounts since the Royal Commission. There certainly, I agree, there was certainly a period there where that slowed. What we've seen historically as well is that the demand for investment consulting services around portfolio construction, management, reporting, always rises after significant market corrections. And I think, you know, that really is as a result of people being exposed where portfolios haven't been properly constructed. We see a big rise in demand for assistance with that as a result of market downturns and greater protection. I think in terms of sort of market observations, if we can jump to the next slide, Toby, is, you know, we've started to see buy-sell spreads, particularly sell spreads widening on fixed income funds. You know, the market has suffered some liquidity challenges, and as a result, in some subsectors of fixed income, in fact, the majority, there has been a widening of the bid-offer prices, which has resulted in managers changing their buy-sell spreads, and that seems to be almost a daily occurrence at the moment, as managers in offering fixed income product try to price that accurately. It has been material in a number of cases. It certainly does add to trading costs, regrettably, at a time when, you know, we really don't need that. But I do think the importance of rebalancing overrides the materiality of that sell spread. It looks significant, but when you're adjusting only parts of the portfolio, yes, it's increased over what it was, but it's more important to continue that sort of rebalancing discipline. Look, alternative strategies where portfolios have alternatives, and this is one of the things that when constructing, I guess, lower cost portfolios, alternatives is almost the first place you start. So the lower cost portfolios, for the most part, haven't stood up as well because they haven't had alternative strategies. You know, we went through a long period, I guess, where people were pretty dissatisfied, let's face it, with alternatives. They have provided some protection through this current drawdown, in that they have fallen less than, and in some cases quite a lot less than, equity markets. You know, I guess leading into this as well, a lot of people have lost faith with the ability of active managers to outperform. That is starting to show itself now. You know, part of the reason why they'd underperformed is any manager with a disciplined valuation process is and was not participating in, as an example, some of the continued rise in pricing of a lot of the tech stocks, both, well, particularly in the US, but at times through Asia as well. And some of those very highly priced stocks have been the worst hit, as we know. So, you know, the underperformance of active pre the market correction is now changing. We have had some comments that, you know, I've got value in the portfolio, or value style growth has outperformed value for a long period of time. In a market drawdown, value should outperform. You know, why is it not outperforming? And that's actually pretty common. When you get sort of market panic and indiscriminate panic selling, as we've had really to this point, you know, there's all styles suffer in that sort of short-term phase. When I say it's normal, it is the case that over time you do see historically value perform more strongly, and I think, you know, that is likely to happen as the market finds some form of bottom. Of course, the million-dollar question is when that will be, but that you know, value stocks, those with strong balance sheets and the ability to generate earnings, will be either retained and highly sought after. So I do see that sort of playing out. So that's sort of, I guess, a quick wrap up of market observations and, you know, our experiences in how managed accounts are working through this period, Toby.
Yeah. Do you have any views, David, on some of the investment types? I know partly from my own personal painful experience that, you know, the LICs and the LITs have gone particularly poorly in this market compared to, say, the unlisted funds at NAV or some of the ETFs. So do you have a view on whether investment types, you know, on the impact of market movement on the, you know, the legal structure of investments?
Yeah, I think that's a good observation. I mean, our listed investment company market varies quite a bit from that of the US, and it varies in that there is a lot more institutional investor participation in listed investment companies and listed managed investments in the US market. So why that's important is that you get much more accurate price discovery. You know, as you know, we've had you know, at least the last 3 years, possibly, you know, 4 to 5, where we've had a big growth in listed investment companies coming to market, and listed investment companies of assets that you know, retail investors respectfully don't fully understand, but we're attracted to because they're generating good yields and levels of income and so forth. So when you get strong retail investor participation in some of those entities, and given that they have been, a lot of them been listed, you know, in very favourable market conditions, they really haven't been tested from a price efficiency perspective. So now we've got the opposite extreme where they're tested to the absolute maximum. So I do think that, you know, there's two things that are leading to that. One is the high retail investor participation in a lot of those structures, and secondly, the lack of understanding of the underlying asset or asset class in which they're investing. So, you know, which really leads to, you know, that big gapping in price and price to NTA and trading and so forth.
Yeah, so if you're listening to this webinar or watching this webinar and you have a question, feel free to use the Q&A icon on your screen. You touched briefly on the slippage issues, David, and I think that's such an important one. But of course, the key point is the counterfactual, which is that part of the reason for those slippages is the price discovery problems, particularly in fixed interest that you talked about. And of course, that isn't a managed account problem. It's a general problem for all investors and all advisors. And of course, you know, so all clients are going to be experiencing that. There's a question there which you might want to take on. Lower cost portfolios, generally higher beta portfolios, generally perform worse in a market correction. Is the demand for lower cost a good thing? And you touched on this, but do you want to go back and talk about that particular issue of the relationship between, you know, market performance and cost?
Yeah, look, I think that's an excellent observation, and that is absolutely true in that from a number of perspectives. So, you know, lower cost is generally going to mean either passive or index enhanced, and so the question sort of highlights the fact that they will have a higher beta. And also the point I made before that almost the first place to start when trying to reduce costs in constructing a portfolio is the alternative space. You know, alternatives are generally more expensive, and you know that's where you've got a limited fee budget. They're the areas that need to be compromised. So, yeah, the questions is correct in that, you know, we've had this big demand and also, I guess, launch of lower cost portfolios on the back of the sort of hypersensitivity to fees and so forth. But they're not holding up as well through, you know, through this market correction. And that's, I mean, to be honest, that's expected. But not everybody understood that when sort of demanding and investing in the lower cost portfolio.
And it's been, I mean, as I deal with advisors who've been considering managed accounts and have been weighing up, you know, best interest obligations, the default best interest test has been, is this cheaper? Those chickens are coming home to roost now. I think there are a couple, the questions are coming in thick and fast, and there are a couple which speak to the other category. And let me just go back to that in the slide we had there. So this other category of about 18 or 19 billion dollars. There are two questions. One talked about super trustee discretion, and yes, that's in that other. And there's a question from anonymous mother of 10 of Werribee. Could you elaborate on what that other comprises? So essentially, other is discretionary portfolios that are not run either strictly as registered managed investment schemes, which almost all the platforms are, or are not run as MDA services in accordance with the class order. So that does cover things like trustee discretion. A superannuation trustee, of course, owns the assets in the fund and can run portfolios. And in some ways, you could think of the pooled accounts in industry funds as being a form of discretionary account, but there are trustee discretion accounts run within super funds. IDPS and IDPS-like fit into that other as well. So these are pools of assets that are run basically to models or in accordance with discretion, but not as registered managed investment schemes. It's grown pretty strongly, as you can see. There's a question here specifically for you, David. What has Zenith learned and maybe changed through establishing managed accounts over the last few years? So that's one for you. Take it away.
Well, thanks for that question, Chris. You know, that's we've learned a lot is the short answer. You know, the whole managed account space has been one that's evolving quickly. And one of the key things we've learned is that each of the platforms have quite different trading and execution processes and protocols. And to be totally honest, you only learn of them once you've got real money in play in terms of around the edges. So, you know, again, that's a non-trivial thing. So in both how we manage portfolios, how we've built the tools to monitor and execute portfolios can differ slightly from platform to platform. And those differences, you know, you need to be acutely aware of in periods like this. So, you know, one example is, you know, there are some platforms that, as well as the strategic weight for the portfolios, both in terms of funds, asset classes, and even high-level defensive growth, also have a sort of shadow weight that the platform will actually trade without the instruction of the model manager. And that's something from a model manager perspective you don't want. You don't want lots of little trades being executed without you having controlled it. So you do need to stay on top of that. You know, we need to be able to communicate to the advisors the trades and rebalancing activity that is occurring, and not have them and their clients asking, you know, why have these small trades occurred, and I've had no communication from the model manager as to why they've occurred. So we've certainly learnt that. I mean, you know, the due diligence process, I probably should have mentioned this in the sort of observations of what's happening in managed accounts. Certainly the due diligence process of the platforms has got far more extensive in terms of approving model managers to manage models on behalf of advice groups. We know that ASIC did send all of the platforms a letter to that extent, that they needed to focus on the due diligence process. And, you know, I think for a period there was, for want of a better term, a land grab for funds under administration, and perhaps, you know, some of those assessment criteria were not as strong as they should have been. I mean, this is exactly the environment where you don't want substandard providers of managed account services managing models. That's just not going to cut it. So, you know, the other thing too, and most of the platforms won't allow this anyway, but really a focus on, you know, highly liquid, daily priced, daily redemption products within portfolios. You know, and even that, like, you know, exposure to things like microcaps, and as I said, you know, some of the credit type sectors at the moment need to be very carefully monitored from a liquidity perspective. So yeah, look, it really has been a big learning experience, I think, for the whole industry, and you know, certainly we're no different, and it continues to change and evolve, and thankfully in our view in the right direction.
That's great. And look, before we go on and talk about some of the regulatory issues, I mean, it's a sort of what you've learned, David, is a natural segue to asking about Zenith itself. I mean, you've been through a change of shareholding recently and have acquired Chant West. So what does that mean for Zenith, and what's your plan for the future?
Yeah, thanks for that question, Toby. So you're right in that we have or do plan to acquire Chant West. The execution of that is due to occur a week from today, actually, 31st of March. What's the reason for that? Well, I mean, the reason is that for a number of years now, you know, our clients have been asking us for super fund research. You know, let's face it, it's pretty rare these days that someone walks into an advisor's office without some sort of industry super fund holding. And, you know, advisors need to know, they need to know information about that. They need to know how it's performed. They need to be able to compare and contrast that with, you know, potentially their own advice on a client's portfolio. So that was an area that we hadn't covered, and you know, again, to be honest, it's not a market that has been known for its transparency. The super fund space from a research perspective, but Chant West had managed to sort of crack that nut you know, they're able to and do have data, ongoing data on performance of industry super funds and corporate super funds, and they have the super switching tools. So that sort of made a lot of sense to us. It's a nice sort of adjacency to the sort of broader research business.
One of the things I'll be particularly keen to see you and others investigate particularly in the industry fund area, is the issue of liquidity. I mean, I know that, for example, there are substantial holdings in Heathrow and other physical infrastructure amongst the industry funds. When you look at the price for the publicly traded airports around the world, which have just been slammed, and in the case of airlines, probably run away to zero value. It'll be interesting to see whether those assets, when they're held as unlisted assets, suffer the same diminution in value as their publicly traded equivalents in industry funds.
Well, that's right. I mean, you know, for quite a while now, in particular, the Future Fund is pretty transparent in its holdings. And as you say, there's and the larger industry super funds we know big holders of direct assets, property, infrastructure, and the like. So that's right. I mean, up until now, with very, very strong inflows from members and new members, and you know that's accelerated post the Royal Commission. Liquidity hasn't been too much of a challenge. You know, that's sort of changing before our eyes. So
yeah.
There's that aspect, and also, as you said, like pricing, protocols, standards, and reporting of those direct assets is something that, you know, we'll certainly be focusing on, and I know Champ West are well and truly across that.
Well, let's move on now to, there are a couple of questions still outstanding, and we'll come back to those, but let's move on now just to have a quick run through of some of the regulatory issues that are outstanding that affect either managed account providers or people who give advice on them. And I want to touch on these 5 in particular, some of which are pretty well known and some of which are much less well understood. So ASIC came out yesterday. So IMAP, through the regulatory group, has had a lot of engagement with ASIC, with FASEA, and more latterly with Treasury on the regulation around managed accounts. ASIC came out yesterday and said that amongst the other things which they're putting on the back burner, the MDA review has gone on the get back to that when we've got time pile. What I can say is that ASIC did present at the IMAP Advisor Roadshow 2 weeks ago in Brisbane. And my take from that, this is not a literal translation, but my take from their presentation was that having spent well over a year looking at platforms, managed accounts and MDAs, they actually had not found cause to take drastic action. And in fact, the review, there appears to have been some discussion within ASIC as to whether in fact there would be regulatory change. But certainly there didn't seem to be an imperative for regulatory change, which suggests that in fact the conduct of MDAs had generally been pretty good. And they cited at the roadshow in Brisbane two instances, one Jade Capital, which was a misleading and deceptive issue around the reporting of performance, I think, which led to the loss of the license. And the other, which they cited, was the, and again, public information, the actions taken in respect of AMP and the use of the no action letters and subsequent advisor discretion. Not much to happen there, I'd say, over the next 6 to 12 months. ASIC had already said that in the event that there was regulatory change, there'd be a consultation paper, there'd be a period of consultation, then there'd be a further period before those regulations became effective, and if required, there'd be a rollout or a phase-in period for those regulations to take effect. I want to talk about the code of ethics as well. We've done quite a lot of work with Stephen Glenfield and FASEA on the impact of the code of ethics on people who give advice on managed accounts, in particular around Standard 3, but in a more general sense. And we've had very good engagement with FASEA. We provided FASEA late last year with a worked example of an advice business using managed accounts where they acted as a portfolio manager in association with an asset consultant such as Zenith. And that worked example's been generally well received. We're going back to modify it slightly, but we think that represents an example of proof that managed accounts used in that way by advice firms can coexist with the code of ethics. That's a very important issue, and one which I feel is going to play out over the next 6 to 12 months. Compensation scheme of last resort is something which hasn't received a lot of coverage, and I want to encourage you to think about this. Rising out of the Royal Commission was a recommendation that there be a compensation scheme of last resort for people who get an award of compensation either through a court or from FASEA. That says they should receive compensation. There's been little unpaid compensation over the last few years, but what we should expect to see as a result of the market turmoil over the last month is lots of claims to FASEA. And to the extent that some of those claims then result in compensation, perhaps I never understood that my portfolio could be exposed in this way. That compensation, if it's not paid by the advisor or product issuer or PI insurer, will be paid by a compensation scheme of last resort. That's to say, people who were uninvolved in the circumstances that gave rise to the compensation, sort of a last man standing scheme. This has the potential to be extremely expensive in the event of substantial failure. RG97 and design and distribution obligations, I just wanted to list there because if you're involved in managed accounts, those are coming. In the case of RG97, 20th of September this year, that comes into effect. And in the case of the design and distribution obligations, April 2021. IMAP will be doing some work particularly on the design and distribution obligations.
Toby, sorry, could I just add, so with RG97, which is the one around the disclosure of fees, that has been a real issue or has presented a real issue, in particular for advice businesses that are moving from, say, model portfolios to a SMA through a managed investment scheme. So for the most part, the platforms are meeting those obligations, and therefore disclosure of fees is a lot more extensive, and it looks to clients and also advisors for that matter that it could well be the same portfolio but moving from a model portfolio to a managed investment scheme or managed account looks more expensive. It's not more expensive if it's the same portfolio. Let's be honest with that, but the disclosure makes it look more expensive. So and that's usually not the case too. Usually you'll have a move from a model portfolio where there's been some changes to the managed account. So there can be the perception that, okay, what's happened to my portfolio? It's become more expensive in the move to the managed account. So it's unfortunately not comparing apples with apples, because the previous regime, as we know, is not operating under the same disclosure requirements. So it's a real challenge in being able to present that and explain that to clients, that it's not actually an increase in cost. I mean, in some cases it's a decrease, but it looks more expensive because of the RG97 disclosure requirements. So, we're finding a lot of work in having to support and provide collateral to advisor groups moving to managed accounts for the first time, and supporting that explanation to clients.
Yep. Look, I think that's absolutely right, David. And one of the things, sort of an analogous problem, will be design and distribution obligations. Part of that is that every issuer has to produce a target market definition document, or target market description document. And that's fine. And MDA providers, for example, already have an obligation for retail clients to make sure that the MDA is suitable, or no reason to believe it's not suitable for that client. But the sort of sting in the tail for that, for issuers of SMAs, will be they then have to go back and subsequently check that in fact the right type of clients have ended up in their products. So I think we're going to see some fairly significant retrospective analysis of clients, which will mean a great deal more information is required at the time initial investments are made. There are a couple of questions which have come up which we might address now. One is there an indication that ASIC are going to require a net asset requirement for MDAs? Look, that's been on the cards for quite some time, and I think so it's temporarily off the table until they get back to considering the way in which considering any regulatory change. One of the things which we are going to do in IMAP, and I'm trying to work through the best way of doing this, and would welcome suggestions from the floor, is a way of demonstrating to ASIC in a quantitative sense, or certainly a documented sense, the benefits that managed account structures have created for clients through this market turmoil, compared to a non-managed, an advised portfolio. So we're working actively on how can we help ASIC to understand the very real benefits that have accrued to clients through having portfolios subject to continuous management and review at a time of extreme market turmoil. David, one for you. Question for David while he's there. Back to alternative asset discussion. Listed market is off by -50% in key monopolistic infrastructure assets such as Sydney Airport or Auckland International Airport. Australian Super knocked down their infrastructure assets by only 7.5%. Do they know something we don't, or is there something better on their books than monopolistic or irreplaceable assets?
Again, great question from Jeremy on this one. So yeah, look, the thing is, and we all know that by having direct assets that aren't valued on a daily basis, that's a sort of artificial way of keeping volatility lower. Anything that's not valued as frequently is going to contribute to lower volatility. And that goes to the point of the valuation. There are requirements around formal valuation and valuation frequency, which is actually not that often, to be honest. So usually there'll be an internal valuation policy. So it sort of goes to your question before, Toby, what is that? How robust is it? What level of independence is there? So I'm not for a minute suggesting, things like some of the Sydney airports and Auckland International are easy to value in this sort of environment, but you know, it's we do need to explore how they are being valued, and how, you know, a group like Australian Super moves that down by 7.5%, where, you know, listed infrastructure assets are significantly lower than that. So it's a great question. I can't answer it 100% without, you know, really seeing that valuation standard and approach by.
That's right. We can only hope that ASIC and APRA are ensuring that there is in fact a level playing field.
Exactly. That's right. And you know, look, it probably hasn't been the case historically. Let's face it.
All right. Look, David. Thank you very much for your time. To all of those of you who've attended, thank you very much for your participation. We'll be recording this, or we have recorded this webinar, and we'll be putting it up on the IMAP site for those of you who want to revisit it. So, look, this is a difficult time for everybody, and so to all of you out there, stay safe. Look after yourselves and those around you, because we will get through all of this, and we'll go back to a more stable and hopefully better informed market. So thank you very much for your participation. David, thank you, and we look forward to you all joining us again in the near future.